We've got NVIDIA earnings at the Jackson Hole Symposium, but maybe what Scott Bessent wants to do, the Treasury's maneuver in the bond market, matters more now to the markets. What do you think?
I think it's great to be with you. I think it matters in terms of the signaling, what the market is going to take, that the Treasury is willing to jump in and try and fix things. But at the end of the day, I think the main concern that we have is regarding the deficit. And when it comes to fixing the deficit, I think we want to start to see some signs, some improvements in that direction. That's what the market is going to be focused on. I think that cutting spendings is really not the solution. The solution is going to be that we get economic growth. And we've already started to see some signs of it with this positive earnings that came out. And what was really encouraging with these earnings was that we saw a lot of breadth in the earnings. It wasn't just a handful of tech companies that reported positive numbers. It was a broad sector of companies that reported good earnings. So I think that's basically what the focus is going to be on.
Yeah, and just one more question before we get into the Fed angle, the Jackson Hole and earnings. Do you think this is the time the debasement trade is back on again? Because you mentioned the deficit concern, but I feel like the U.S. government, the Treasury, wants to sort of grow its way out of it, not necessarily talking about spending less going forward.
I think, if you look at the budget and if you look at the spending, a lot of that spending is non-discretionary. A lot of that spending is interest payments. A lot of that spending is defense payments, right? So their hands are relatively tied when it comes to trying to control spending. And I think practically speaking, that is not a very likely scenario for us to be cutting spending. I think what is more likely is for growth to happen. And I think what we are looking at right now is the deficit to GDP ratio. Is that going to improve? And we are of the school of thought that because of the productivity increases, because of artificial intelligence, we should start to see some improvement there, although it does take time. And I think that, again, the positive aspect of this is that AI is now starting to, what we saw in these earnings reports, was that AI is now starting to make its way into the rest of the economy and is not just confined to a handful of technology companies. So I think growth is the way to fix this, and the improvement in the deficit to GDP ratio, that is really going to be the key going forward.
Aadil, at the end of the day, the stock market clearly has a rising term premium problem, doesn't it? How long is this going to be a drag on risk assets and equities? And what is the number one portfolio adjustment we need to make in this current environment?
Yeah, great question. I mean, I think that as far as what we really feel is that when this market does pull back, right, you got to be ready for a pullback in the market. And the way we are looking at it is that this pullback is not a bad thing. It's a healthy thing. Since 1980, we've had an intra-year pullback of on average of 14%, and 75% of the time the market still ends up going higher. So the key really over here is that when that pullback happens, you want to reduce your downside risk and be opportunistic. And we feel that in order to do that, investors must improve the breadth in their portfolios. What we are seeing more and more, Shri, is that a lot of people, because of the parabolic run-up that we saw in some of the technology companies, a lot of people are very concentrated in a handful of tech companies. Even if you look at the S&P 500, 1/3 of it is just the Mag 7, which is severely underperforming this year. So we feel that investors going into the market right now must improve the breadth in their portfolios. This way, if the market goes down, their downside is limited, and they also have the ability to be opportunistic and get involved in some of the sectors on a pullback.
Let's go deeper into that line of thinking, Aadil. And we are awaiting NVIDIA, but we have heard from the hyperscalers, the chip makers, software. What do we own then, and what do we avoid within that ecosystem?
I think what we are within that tech ecosystem, if we are talking about that, the way that we are guiding our clients is have breadth within that ecosystem, right? You want to be invested, you want to have some exposure to the Mag 7, of course. NVIDIA, we think, is a great company. And in our view, they're going to report great numbers. But how operating margins should go up, revenues should go up substantially. But how the market reacts after that, whether the stock goes up or down, is very difficult to predict. But what we definitely want to do here is that within technology, we want to have breadth. So if you look at the Mag 7 as a whole, and if you look at the weighted average of the Mag 7, you'll see that year to date, they're not even up 2%. But other areas of technology, for example, semiconductors, for example, cybersecurity, those have done extremely well. So for us, within that ecosystem, investors should have broad exposure to all areas of technology rather than just being stuck in a handful of companies. And within that, you got to make sure that you have firepower so that if there's a pullback in any one of those areas, you're able to add exposure there.
So where would you advise your clients to add when they have the firepower, there is some kind of a rollover or a correction? Is this the right time to think more about AI beneficiaries rather than AI enablers? The familiar suspects in AI trades so far has been really the semi-trades, the memory trades. Do you think it's time to sort of move on and maybe revisit later?
Yeah, absolutely, Sherry. I think that's you hit the nail on the head. I think that is really the key right now, because the way that we are describing it is 3 phases of AI. Phase 1 was your AI winners, which is your tech companies, your hyperscalers, your semiconductor companies. Those names have already run up quite a lot. So a lot of this has gotten priced in there. But now we have to think about the AI enablers, the companies that are building the infrastructure for AI. Now think about this $800 billion in CapEx spending. Who are going to be the recipients of that? So there we are talking about utilities, we are talking about construction, we are talking about energy. And there we do see a lot of opportunity. And then we are also talking about the AI beneficiaries, which are essentially companies that have now actually implemented AI into their businesses, and they are seeing meaningful productivity gains. So our guidance to clients is that maintain your core exposure in the AI winners, make sure you're broad. AI enablers and AI beneficiaries, we do see a lot of opportunity there, so make sure you're invested across all 3 phases of AI.